In trading and investing, timing is everything. If you bought the NASDAQ in the year 2000, then it took you a long time to get your profits back. Yes, it happened, but you were in for some pretty bad years. Conversely to that, if you bought Japan during the 1990s, it took you well over 2 decades. So what's going on right now in the markets, and should we be concerned about a similar occurrence happening again? Well, there are some charts that we need to be watching together for the coming weeks and months. One of them has to do with bonds, and the other has to do with the biggest banks in the world. What's going on? Well, one thing is clear. A lot of signs are pointing towards commodities and gold being something that we all should be continuing to look at. Join us as we go through stocks, commodities, and cryptos for the week ahead. Well, welcome back everybody to The Daily Show. This is the special weekend edition. My name's Tom, and as always, we're going through everything that you need to know for the weeks and months ahead. If you've ever asked yourself the question, why do markets do what they do and where are the flows moving? How can I better understand where the biggest players are? Then remember, subscribe and smash that bell icon. We do this daily and we go through to give you alpha and edge together. So let's begin today's video by discussing bonds. Then we'll go into alt assets. And then of course, we'll have a look at the hottest charts right now and the key levels that you need to be watching. So what's going on with bonds? Well, triple C's minus B's are starting to widen. Basically, we're seeing a difference between higher grade spreads and lower grade spreads. Junks aren't necessarily the thing to be in anymore. And this is telling you that the bonds market is sending a warning. Whenever you have yield inversion and you start to get this kind of decoupling of the overall bonds market, you need to start saying, well, I question whether this is so healthy in the back end. But that doesn't mean you just instantly sell. Of course, every read needs to be brought together with many, many other reasons. Now, if you've been doing your kind of research, you would know that we yield inverted back in 19 and that we are 500 plus days of yield inversion right now, which is basically where you get the US 2-year or the shorter date spreads and you compare them to the longer date spreads. And you find that somewhere in the future, the bonds market is predicting effectively a recession. Now, of course, we're not discussing recession anymore because no one wants to talk about it. It's now over. 2022, everyone thought there was a recession. It didn't happen, which was almost a miracle. But of course, that's what did happen there. And then we led into a very nice bull run led by AI and innovation. But what about excess savings? Is the common American, and in fact, really the global consumer, starting to weaken post all of that injection that we got from 2020 and the governments? Well, as it turns out, yes, we've just turned negative. Obviously, if you've been looking at credit card data, you would know that that's been ballooning and people are basically in phantom markets. Buy now, pay later has become one of the most popular things, and you'll notice it's not really tracked a lot in the metrics. So how is it then that with high interest rates, we're still booming? Well, one of the reasons I believe is because the banks are lending a lot, and in fact, maybe they're not doing the due diligence. Does that sound familiar? Well, it should, because of course that was something similar to over here. But really, I think it's the difference between the bank deposit rates and the Fed funds rates that's allowing some of the largest banks in the world to really make bumper profits. And of course, as long as that continues, it really shows that debt is being compiled on debt that's being compiled on debt. Now, if you weren't paying attention, you might not be aware that several smaller banks are struggling in this environment. They don't have as much deposits. They're obviously struggling to lend, and a lot of them are, of course, in the commercial area. And there's no doubt there are problems in the commercial real estate right now. Is that enough to bring the markets down? I don't believe so. But here's another one that went bust just a few weeks ago. And of course, it was seized basically at the end of April. Now, why is this important? Well, we're not hearing about it anymore. We're in complacency stage. Oh, yeah, the bank will be saved by the Fed, blah, 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 blah. And of course, that's up to a certain point true. But it is something that you'll need to keep an eye out for, I believe, over the next coming years. And a lot of it has to do with where we're at in a business cycle. So ignore this for a moment. I posted this over on X. If you ever want to join us over on X. Links in the description down below. But what you'll notice is that we're starting to see some signs here. And I've been talking a lot about financial stocks and utilities recently, along with, of course, my big calls on commodities and our discussion about gold and how we think that's going to do quite well moving forward. But actually, this is a lot of general economic theory on business cycles and kind of late stage cycling and concepts. Now, I don't like this chart, and I actually think this is heavily flawed. But this is what you'd traditionally learn if you went into kind of any economics 101 course, and they'd say, oh, yes, you should be buying these things at the end. And then, that will tell you you're in late market cycle. And a lot of people are questioning whether we're here or wherever we are in particular. What I think, though, is that clearly we're going to need to look at utilities, finance, and a couple of other leads throughout the next coming years. Because as long as these financials are continuing to strengthen up, it basically means the debt wagon is continuing and that people are just compiling bigger problems, sure, but of course timing will be everything. So both XLF and KRE, which is regional banks, so the regional banks that aren't actually completely getting bust, and remember a lot of those can be plugged over time, we're seeing them start to push those new all-time highs. So is that a good sign for the bulls? Yes, I think it is at the moment. What do you think, though, in the comments down below? Do you agree that that is a pretty good sign? Some other weird areas that I think are worth paying attention to, we've actually seen retail food and service sales start to flatline. Now, if you have a look at any other previous period in time before recessions, this is pretty common. We usually have this huge increase and then we flatline for quite a period of time. Now, you might say, well, this is no timing technique. This sucks. What a crappy indicator. It does tell you, though, that because we're flatlining like this, people are starting to struggle underneath. And of course, that will come as no new surprise to most of us out there. We probably have family and friends that are starting to struggle out there. And they're starting to say, well, I don't know whether I want to buy this bell pepper or potentially this zucchini. Which one? Well, I don't know what's called in America. It's probably a different thing. Someone can let us know in the comments. But, these choices are having to be made by people because they're struggling in this higher interest rate environment. So what does that mean? Are we in complacency? Are we in a period where we need to be worried and we need to be really concerned? Well, as we often say, we say patience, react, don't predict. So it's not that we're not getting some warning signs, but at the same time, we need to be following this price action. It's something we do here on the channel. And of course, it's allowed us to discuss this recent bull move and where we are right now. But you may be surprised when we look at the options later to what the market's actually doing as of Friday. So what about the CBOE of the VIX of the VIX? Basically, is volatility underneath the overall volatility declining? Well, the answer is quite simply yes. And it's getting to really low states, which basically tells you that it's cheaper than ever to buy hedging again. So notice here that hedging is starting to get incredibly cheap. This is SPY, US equities, and Qs in terms of puts. And you'll notice that they're kind of in the hole. Now, that tells you that the market is generally complacent and that people aren't really buying puts. Now, that doesn't mean go out and jump into 1 week and 1 month puts because they're not going to do very well for you. But it does mean that, in general, people aren't very concerned about the markets. Now, on one side, people aren't concerned. On the other side, we're seeing people very concerned. Let's get into some alt asset discussion. Global annual gold demand is actually increasing at a big rate. But notice that it's not the ETFs, not the exchange traded funds, it's the bars and the coins. And as we've talked about for a little while, this isn't actually retail traders, this is central banks. If you've been following my theories and our theories about where we're at in terms of overall longer term cycles, you would know that we're most likely in what we call a currency war. And to back a new currency, you usually want to be using some kind of system like gold. And of course, central banks around the world, in particular China, Russia, and a few others, are purchasing up big time when it comes to what's been happening in recent times. And if you think about it, this is the breakdown that happened during 2020, kind of 2010 to 2022, and where we are right now. Central banks are playing a way bigger part, which is starting to accelerate, by the way, and that investors, that is mostly retail traders, got pushed out as well of gold. So we've been a big bull on gold. Of course, I have a theory that gold's going to 3,000. I might have to actually upgrade that theory based on some of my metrics on valuations in the future. But yeah, there's a big case here that something is going on from central banks and that the big money is flowing into these pairs. And we've been talking about this for quite some time. So why could this be? Well, of course, there are always theories about why gold is good. And these are the three main theories that people have. So massive increase in government spending equals one of these kind of overall eventual scenarios. Option 1, option 2, and option 3. If you have which option you think it's going to be, let us know in the comments. I did post this to X, and most people were saying option 2. So basically monetization and currency debasement. So this is clearly what's happening to a number of countries, especially in the US. I would argue it's happening to all of the countries that are printing, and pretty much that's every single one of them. So you got to remember, if every single country is printing, then the US dollar is still just as powerful versus all the other currencies that are printing as well, because it's all comparative. That's the thing about fiat. Whenever you think about currencies, if everyone's printing and you've got the major, then the major is still very, very strong. And I've already said this before, the US dollar will not be the one that goes first into a bust. It would be another currency way, way, way before that. You do not get rid of a major quickly. So the US dollar is still the king or queen for now of the major currencies in the world. So US treasuries are now actually more volatile than gold. This is the first time in 45 years. As you'll notice, the first time in 45 years. So therefore, when was the last time we had that? Most likely the 70s. So the 70s was a pretty glorious time to be stacking gold and stacking silver. We saw all those crazy moves in oil as well at that point. So it just kind of shows you it's pretty normal there. So we'll go into gold and the key levels of where we're at right now a little bit later on today's video, but let's go into whether the stock market actually looks bullish for now. So first up here, we have advanced decline lines. Now we've been talking about this a lot, and we did end up seeing a new high on the advanced decline line just last week. Now that usually leads into further bullish action on markets. Now you could argue sometimes that's kind of like a more topping, double toppy, slower process, but a lot of the time there's still a bit more to run. And this goes into a theory that we've been talking about in terms of where we are in the bull market cycle. So you can see here breadth, momentum, all of these things are thrusting up in recent trade, suggesting that pullbacks are going to be met by bull demand. And of course, a lot of this is led by AI innovation and forward earnings that show that maybe companies are going to be able to fire staff, get more efficient, do all of these types of things. So where are we in the election year cycle? So as you would be aware by now, if you've been watching the channel, election years are generally bullish. In fact, they're historically pretty much following a very similar line, especially if you were looking at 2012, which is this red line here. Now, it's not uncommon to have some questionable periods in most of the election years where we are right now, up, down, all around. But then we drive higher, have problems often in that September, October, November area, and then we tend to drive higher as we get into the election, get into the certainty of where the market's at. So what does that mean? Well, it means that this could be the path of the rest of the year, but ultimately price action is going to be dictating it. It also tells you that if you believe we started a new bull market in September of 2022, then we're starting to get near the median duration. Now, you'd remember before that we have that business cycle. So if we have a business cycle that lasts whatever period of time, they often say between 4 and 7 years, then if we believe it started at this period of time, then it probably leads into thinking that there's a bit more left in it. In fact, the median duration's between 31 and 33 kind of months, and we're nowhere near that just yet. And there have been cases of some epic bull markets that have, of course, kept running. As we've long stated on this channel, really what we're looking for is probably the uninversion of yield curve to start thinking about being careful. And if markets actually still keep going up and everyone keeps ignoring that signal, especially if it's 6 to 12 months later on, that's when I think, we should all be the most terrified about these markets. So it brings us to the point of the start of the article today. 1% returns over the next decade. Is that actually possible? Well, as it turns out, when we have PEs as high as we do right now, historically, we're in a period that haven't been really seen very many times. Now, you could say these times different AI stocks, biggest stocks in the world, most concentration, etc. Certainly there, global markets, all of these types of things. But one thing's for sure is that we're not really cheap on these markets, and that if you get the timing wrong, of course, things could go very, very badly for you, at least initially. If you go over the long term, of course, 1% per annum, what that's kind of showing you is maybe we go up like this, dump down, then rally up, and higher. But overall, this is a big issue. Now, of course, that's ifs, what's, bends, and buts. But let's have a look at the market and what it's actually telling us about what's been rotating recently. So on Friday, we had semiconductors. We also had staples and financials coming through. A weird combo indeed. Staples, financials, and semiconductors. It's pretty strange. Then when we look at the last 5 days, you're going to notice that it is also quite a strange combo. We've got gold stocks, we've got utilities, we've got financials, and semiconductors. So really what that's showing is that we have a mixture of defensive style properties, late cycle style investments, and also the greatest technologies that are coming through, such as AI, boosting it up. And this is what we've kind of argued. It's not necessarily a great market for necessarily indices. It's actually a great market for stock pickers and people that know where the flows are going. In fact, you've been able to get massive superior returns this year by being able to pick those right sectors. Gold, commodities that we've discussed a lot, epic returns, even compared to semiconductors, which have been floundering a bit since the February kind of sell-offs. So what's going on with the S&P 500? Let's do a breakdown here before we go into some more data, and then of course the keys for all of the other charts around the world. S&P 500 first up, long leg doji on the main market, showing us that we're at a point of what I like to call equilibrium. So basically it's at a resistance. If we break above, then we're in a positive gamma situation, which basically means that options continue to stack on top of each other. And we managed to close just below the 52.25, which meant that no extra hedging had to occur on the Friday set. The advanced decline line, as we mentioned before, is continuing to increase, which is a good positive, maybe medium to longer term sign. And when we have a look at the futures, you can kind of see here that call resistance, which is there for the Monday. We've also got the Monday one-day expected moves, is starting to, act as a little bit of resistance. Possibly we start to see a little bit of a sell-off. Now, if we do get a sell-off, there are some zones that you'll want to be paying attention to as a bull this week, and some zones as a bear that you might want to say, well, I don't think the markets can easily get through that. You would notice that we have very good structure around that one-day expected move, and we also have what we call a HVL. So basically where we turn from possibly a positive gamma into a negative gamma situation again. Somewhere around 51.65 to 51.85 is where those kind of bulls should sit this week. If markets fall underneath that, then it opens up, much more significant sell-offs, and we need to start then looking at all of those other things. 17,800, for example, on the NASDAQ. But for now, there is a series of higher highs and higher lows. So for bears, they're going to be looking for sell-offs back down to this level and then saying, okay, what happens here? Who is in control of this market? Is it the bulls? Is it the bears? The bears push it below. Then we can start talking about, getting down to more significant levels. But for now, you can clearly see that the bulls were in control of pretty much most of the sessions, except for the Friday where we did see that sell-off after the rally in the morning. So what does that mean moving forward? Well, let's have a look here at the options market. Again, 52.25 broken through. That's going to start pushing that 5,300 narrative this week. We do have a lot of information coming out. We've got inflation reports coming out this week. We have, of course, options expiration for May. So it's the OPEX again, which means that trillions of dollars are at stake. And because we're in the positive gamma environment, if we start to push forward, 5,300 is going to be most people's target. So 52.25, we close above that point, 5,300 becomes a lot more likely, something to be watching out for. What about CTAs? Well, we saw NASDAQ CTAs, we saw S&P 500 CTAs, both sell off. We've seen gold CTAs hold very strong with big moves of silver and gold last week, leading to some strength. And we actually got a little bit of a sell-off in Brent CTAs, following what we thought was a very nice level, and we still do think it's a very nice level for the bulls to recommence into their oil bets. So incredibly important chart here on oil this week. Let's jump through some other charts before we get into the rest of the stuff. First up here, interesting model here, the Fed model. It's basically looking at bonds in proportion to equities and whether it's a good time to own either or. So, you can really see how ridiculously expensive bonds were. Never, ever. The reason I inputted this chart in is just to show you how bubbles form. This is a ridiculous bubble. I remember, and I've always said this, most of my trading career, which really started in here, was I never looked at bonds much. And you might say, well, Tom, look at the bonds. Look how crazy they went. Yeah, but the thing is that they always didn't make sense. So they were always quite wild. And most of the time, the stocks still did way better than the bonds. So it wasn't, why would you take on such a risk? But that was a huge bubble. You can see the massive discrepancy. That's since, of course, corrected. And we're looking at a 5% cheaper for bonds. Now, does that mean you go and buy bonds? Probably not. It's not necessarily the most, it's a decent time for treasuries. But of course, most people have been hating on bonds. And again, timing will be everything. Is bonds good now? Well, might be a few years here before we see any weakness in the real markets. So markets go up 20%, 15%, everyone gets excited. Bonds paying 5 or 6%, well, you're going to be behind the curve, aren't you? What about the chart one here, which shows you that Q1 inflation often is the highest point. So of course, now we're going to start questioning what's going forward. This is just an interesting little chart here, just showing you that inflation usually for the Q1 is then, sent down, at least in previous terms of what's been happening. Maybe people are getting a bit ahead about themselves. That will also move yields a lot. Obviously, if inflation does drop, which I'm not sure if it will or not. I mean, with the debt creation, I don't think it really will drop too much, but we'll see what happens. Then we end up getting, of course, a lot of move in the overall treasuries and the yields. Now, what's going on here from the Dow Jones perspective? As we showed before, we do think that we're in an advanced decline increasing period here. That is kind of backed up also by some very positive signs here from Dow Jones. 7 up days in a row near multi-year highs. That tends to suggest there is further bullishness to come, and with pullbacks being generally met by bull demand. Now, some people are also mentioning this. Staples and utilities both making 52-week highs over the last week. Now, I love utilities at the moment. I've been a huge supporter of those since back end of February, and I do continue to think that utilities will well outperform staples in my mind over the next coming years. But yeah, new 52-week 2-week high. Do I look at this and say, wow, it's so defensive, it's terrifying? No, but I do certainly say that it's showing signs of catch-up, which usually shows signs of a broadening market, which on top of that, you need to start looking for the signs of late cycle investing. Percentage of S&P 500 stocks above at 20-day new timed highs, certainly getting a lot of thrust here. Recently, we saw that get crushed during that sell-off. So again, kind of pointing towards a decent amount of strength on these markets. Same thing here when we're looking at the moving average direction dashboard here from Grant Hawkridge. And you can see utilities is 100, which again, now it's pretty much seen. But before that, we already saw the underbelly of utilities improving, thanks in part and pretty much mostly due to price action analysis. So you can see here financials and utilities both leading the curve at this point. So how do markets perform around certain events? Well, shout out to all the mothers out there. I hope you had a great Mother's Day and you're enjoying your time with your family. And of course, there are some good news. Day before and day after tend to be relatively positive on the markets. I wouldn't look too much into this, but 18 up, 11 down the day after Mother's Day in terms of trades. What about earnings? Well, there are some big kickoffs this week. Of course, Chinese stocks in focus, specifically Alibaba, SE as well, another one that a lot of people will be looking at. Home Depot will be an interesting watch. And also Rumble coming out. We'll see how that ends up playing. Now, let's move over to what that means for us as investors and traders. Do be aware of the options market. The options market is dictating plus minus 8% on Baba in terms of its earnings. Take Two is also 8%, and Under Armour is plus minus 11%. So some big options market moves this week, and you will need to be aware that those are at risk in terms of your client portfolio. So what else is showing signs of bullishness at the moment? Well, you can't be hating on things like home builders at this stage. It's continuing to expand. Yes, it's not an all-time high, but it is recovering. Now, whenever we see home builders going up, that is generally a sign that the economy is expanding at this point. So something, of course, we will be looking at. The VIX is dropped down into kind of, territory where it just got absolutely crushed. That is a surprising crush, I'll say you that. Like the crush was huge. We also knew that once it got underneath here, it was kind of pointing towards a new all-time high. But at the same time, that is quite crushed without any normal secondary spike. I kind of do expect one, though I do think it'll be met by bull demand. But yeah, we're back down into these 12s. So, of course, VIX is quite low. Now, why we're starting to expect maybe a little bit more volatility this week, this one here. We talked about bonds at the start of the show, but this is actually bond options. And what you'll notice is we've now had 2 to 3 days of spiking up. What was this? Yeah, it started spiking as of Tuesday last week. So really, as we're hitting into these highs, as we're seeing that little bit of a rejection kind of candle at that core resistance, we're also starting to see bonds or bond options starting to spike up. Now, this has been a pretty good precursor of markets getting a little bit more volatile. It may be short-lived, but I did see that come up, and it means that price action, those key levels, may need to be watched fairly closely. Treasuries sitting around, they're going to wait for the inflation number. Of course, if yields go down, treasuries will go up, and we've already talked about how this is a very decent level for the longer-term hodler. Now let's talk about S&P 500 and central banks. Central bank liquidity as the market goes up. You might say that's sick. I would say it looks okay, I guess. So what about the US dollar? Well, it fell off at the exact perfect time last week. We've since consolidated a little bit. I'm looking for US dollar to rally possibly into weakness. And this is a very important point for the US dollar. If it's going to find weakness, you would think it's got to do with yields. And mostly this is going to come off the inflation number. So do be aware of that. Big rejection here on the daily last week. For bulls, you'll be wanting to look at maybe a 105 kind of 80 breakout above. That's going to be very bullish for the bullish dollar players. But for me, it's starting to look weak on the charts. When we move over to something like gold, you can see here that we have a nice breakout to the upside. When we go to the weekly, It looks kind of the same, nice closure. And gold may have just come out of consolidation. So central banks are buying, Chinese buyers are getting in big time. I've already talked about the fact that they're buying gold beans, a lot of fakes out there as well. Be very, very careful if buying physical gold. Make sure you get that stuff tested, guys, because people are selling all sorts of gold covered stuff. It's like the it's like the thing that always happens in history. But yeah, you better buy the right stuff if you are buying it. Anyway, gold on the futures market, you can see here is increasing. That's break to a new high. That means that we may have just put in a low. Same thing with silver, which gave us the first initial signal, pointing towards hopefully getting some further strength on it. Mark out that 2881 kind of, or 2880 level, because if that gets broken above now, very, very bullish for silver. And again, we saw that starting with those tweezers down the bottom. We started to think that was going to happen. Now, do I think silver will outperform gold moving forward? I think for a little period it may. And that's because we're looking for silver to get back to that ratio of 0.015. Now, silver's like Ethereum in Bitcoin, in crypto, yeah? It moves more wildly and it gets kind of crazy. So just remember, silver is dangerous like that. What about US oil? Not probably the move a lot of people wanted. It came off this supply. Very unfortunate it didn't manage to break above this point. Now, I had a suspicion up till pretty much where we are right now here that we would find buyers. I'm not necessarily concerned it's come down here. It does take a little bit to stop a freight train. And right here would be where I'd like to see a buyer. But we have absolutely no structure. So what that means is that it's just come down like a freight train and there's no small time frame, like, consolidation with a bit of a move up or anything like that. Now, I often do say patience, react, don't predict. I could see why people are scaled into oil right now, but it hasn't turned this area. So it's sometimes okay to give up a few percentage points to make sure this thing wants to turn. And I would think that it's the right level, but very unfortunate high here. Really didn't do what you'd hope it would. I'm still bullish on oil here. I am very much paying attention to it and looking for that next big move. Obviously, CTAs did sell down slightly. Now let's move to some of the biggest stocks in the world. Tesla trading around the most traded zone. Looks like it's going to come maybe for the fib, which is fine by me. I think 162 could be a very good level for Tesla. I do think there are some concerns still on this stock, but again, opinions aren't really worth it on this stock. Instead, you're looking for price action, and what you're doing is you're waiting for the signs of bulls to come back in. If you're a Tesla bull, you want that high now taken, which is the price of 176. And if you're looking for the next level, because we haven't got a sign of buyers yet really coming super in, except for that initial little green day, we're looking for that 162 to be hit. The 61.8 fib pullback, golden ratio, all of that type of stuff getting in. Apple stock holding their own. Could it be creating an island reversal? It's possible. We've got that big gap up off the 110 billion. If we do end up getting a gap down, that could start a little bit of selling. So watch it. Certainly watch it. No easy entry on that at the moment. Utilities doing incredibly well, reaching my secondary target in terms of just like shorter time frame trading stuff. But utilities just been smashing it, guys. Probably reaching, I would say, some consolidation. What I'd like to see utilities do is something like this and then break out. 52-week high, obviously not the highest point it's been since 22, but very nice moves there on utilities. German 40, very strong index. Oh, wow. It shows you again, I think the financials and the old economy stocks are running. German market making a new high. I wouldn't go against it, though I probably wouldn't enter into it either at this point. HSI, Chinese stocks doing very, very nicely. Excellent rallies leading into our 20,000 target, hopefully. And yeah, for now, I don't really see too much weakness on the Chinese stocks. Alibaba will be an interesting watch. Aussie 200 holding its own, similar to the UK 100. Anything to do with commodities, banks, and energy and all that type of stuff right now, metals, is doing well. This is a market that's filled with that stuff. So you can see it's come up, sold off a little bit. As long as the US market grinds or even does anything, I'd expect probably the Aussie 200 to outperform it. US 2K, now it actually hit 2084, the perfect level. This is where we thought the bear sat, and it hit it and it sold it. So it's similar to all the others. We are still in a bull market, update here on these charts, and we're still making a series of higher highs and higher lows, but that could all change at around 2040, 2030, and then expose 2K, which is where I think the next buyers kind of sit on the Russell 2K. So yeah, a little bit of weakness coming off the area where I could see bears sitting. We'll have to really watch the SP 500, I think, for this. And we've already given and talked about the key zones there. So Russell coming off that 2084 almost to the absolute T. If you did sell that point, well, I guess well done to you. NASDAQ, similar thing. It's actually through the red box. Did reject a little bit. No break below. 17.8 still where I see the bulls. And for now, it's kind of doing a bit of consolidation and kind of climbing that wall of worry. So no exact signs of superior weakness. Maybe the Russell is the weakest looking chart. Sometimes it leads. For now, though, we haven't broken the S&P 500 level, so I'd say it's too early to tell. Bitcoin, bit depressing coin really at the moment, selling off and moving back down to almost the 60K level. So I did see the possibility of a bear sitting here. This is kind of where I see the bulls, and we're not really seeing incredible rejections off Heritage Zone. I'd like to see it kind of come down here and get a big wick, then go bullish. That would be pretty nice. Or if it wants to go bearish, well, then just do it. But for now, I'm looking at the 61.8s where the bulls sit. And if you want to get, if you're really feeling Bitcoin super long, you want to take that high out, make a new higher high, kill this downward trend that's currently in here. Because remember, this is a downward trend now. It's a low, and then it's a lower high, and then it's a lower low, and at the moment, still a lower high. So it is a daily downtrend. But yeah, we know where the bulls are. And if they can hold it up, well, that will be quite strong. So this brings us to the news component. And of course, we have two big bits of news, PPI and CPI on Wednesday. This will be the volatile one on Wednesday, along with core retail sales. To summarize the market at this point, I would say that it is still quite robust. It is moving up with the correct sectors that you would expect at this point in the cycle and this point in concepts of America's history. The other thing that you would generally be looking at is price action. Ultimately, we have not made any real bear cases for the markets from a price action standpoint. So you're trying to pick tops at this area unless you're day trading or scalping. And there are some signs this week that maybe we'll get some temporary volatility, depending on where, of course, core retail sales ends up. So positive gamma environment, guys, generally bullish market in the aspect of what we're looking at. If you want to find out more about what's been occurring and what's happening in markets, remember to subscribe and smash that bell. And of course, join us on the other social media platforms as well. We're always glad to have you there. Have a great weekend, and shout out to all the mothers out there. I hope you have a great Mother's Day.